Hi, Justin. Welcome, and thanks for joining us for a wrap-up of Q1 2021 on the global listed infrastructure sector. It's certainly been an interesting quarter for the asset class. There are noticeable differences between January, February, and then March. What happened through the quarter?
As we all know, 2020 was an extraordinary year for global listed infrastructure and equity markets in general, with the pandemic that swept the world. It was quite dramatic in the way that global listed infrastructure underperformed global equities right through 2020, and that trend extended into January and February this year. Indeed, at the end of February, global equities had outperformed global listed infrastructure by over 25% in US dollar terms over the 1 year period. That's an extraordinary statistic, I think, and in the month of March we did see some turnaround of that trend. So the month of March was very strong for global listed infrastructure and global equities as well. And despite the rising bond yields that we saw, global listed infrastructure did make a recovery in the month of March versus global equities.
Digging deeper into the performance, can you give us some views on some specific sectors and how they performed?
So in the month of March, we saw a turnaround in a lot of our holdings, particularly in the US regulated utility space. But the standout for the quarter for us was the North American pipelines assets. Now, the pipeline stocks that we own don't have direct commodity price exposures, but the firmer oil price, due to better demand over the quarter, did help those stocks. It helps the pipeline stocks in terms of potential future growth, and also it reduces the counterparty risk that we see for some of the shippers on those pipelines. So the pipeline stocks that we hold, such as Kinder Morgan, Williams Group and Cheniere, were all up over 20% for the quarter. And we also saw some good results from the pipelines, which always helps as well. For example, Cheniere upgraded its guidance for 2021. Cheniere is a US exporter of LNG, so they managed to raise some new contracts and completed or got near completion on a new LNG train that they're developing. So that all helped sentiment for the pipeline space.
We had almost a near unprecedented cold snap in the US as well. How did that affect some of the stocks you own?
Yeah, that really helped the gas pipelines in particular. I think that what we saw in Texas over the quarter really showed that there needs to be diversification in the energy sources. And whilst we're big believers in the energy transition and have a lot of particularly electric utilities in the fund that are benefiting from the reconfiguration of the power grids for that energy transition, we do think that gas will play a role within that energy transition for years to come. And that was proved out in Texas with the very cold weather, where gas was shown to be a reliable provider of energy.
Towards the end of last year, we had some really positive news with respect to vaccine rollout. That continued further into the first quarter of this year, although there was noticeable divergence in the performance between toll roads and airports. Could you give us a little bit more colour on that?
Yeah, so I think for us, it's a divergence in outlook. Actually, over the quarter, despite the rollout of the vaccines mostly succeeding or going quite well, with some notable exceptions, particularly in Europe, the vaccine news was overwhelmed for a lot of the transportation stocks, and they actually underperformed over the quarter in terms of share prices. But we're much more positive on the toll roads than we are on the airports. We can see a clear pathway to recovery for the toll roads in terms of traffic, and for the average toll road, it depends on the road, but we think that traffic will come back to pre-COVID levels by the end of this calendar year. It's more complex for airports, particularly in the very lucrative long-haul travel market. We expect to see some positive announcements over this year for the airports. For example, earlier this week we saw that Australia and New Zealand is close to forming a travel bubble, which will certainly help things like Sydney Airport. But as I said, there's a long and uncertain pathway back to recovery for airports, and we much prefer the toll roads. So we've been continuing to add to toll roads in the fund. And in particular, we've been adding to Transurban and Ferrovial over the quarter.
I know quite a few of us are looking forward to getting back on long-haul flying, Justin, so interesting point that you made. Earlier, you referred to a rise in bond yields. I think that was something pretty significant we saw this quarter. What impact has that had on the sector?
Yes, bond yields are always a vexed issue for all, I would say all asset classes, including listed infrastructure. And certainly over the quarter, we did see a large increase in long bond yields around the world as the market became more enthusiastic about an economic recovery as we move through this year. Just to rewind the clock, it's important to remember that bond yields, long bond yields around the world are still less than what they were at the start of 2020. So we saw the decrease in bond yields last year due to COVID as being a temporary thing, and that's indeed played out. And if we look at the chart, you can see that the US 10-year rate has indeed increased a lot over recent months. But what we focus on most in the infrastructure space is the real yield. So that's the nominal yield adjusted for inflation. And if we look at the chart on the right-hand side, you can see that the 10-year break-even inflation rate has risen dramatically also to nearly 2.5%. So what that means is that real interest rates have risen far less than the nominal rates. And that's particularly important in the infrastructure world because a lot of the companies that we invest in infrastructure have an inflation pass-through within the mechanism or the regulation that the company might have. Some good examples would be toll roads around the world, where many of those can pass on the inflation of that country, usually on an annually basis to the users of the road. So there's an inflation pass-through there. And in that way, you can see that real rates are far more important. Or if you look at things like regulated utilities, such as a regulated water utility in the UK, which operates under real regulation, where they have a real asset base that is indexed to UK inflation. So in that way, the company is protected from inflationary increases. So when we're analysing the companies, we're very much focused on the real interest rate, much more than the nominal interest rate.
One of the other major events we saw through the quarter was the announcement by the Biden administration of a significant infrastructure stimulus. What effect do you think this will have on the portfolio and the sector more broadly?
Yes, well, that in itself will probably be inflationary, given the fiscal stimulus involved there. For the infrastructure sector, particularly in the US, we think it's a modest positive. A lot of the infrastructure expenditure will be public money, so that won't be directly beneficial for the infrastructure companies. But in particular, where we get excited is that the Biden administration is very much on board the clean energy transition. And as we've been talking about quite a bit, particularly last year, where we were buying a lot of the US electric utilities, we think that there's a big opportunity for many years to come in the US clean energy transition. And the Biden stimulus plan, we think, will be positive for that transition in terms of the electric utilities themselves investing in the power grids to enable the rollout of renewables across the US.
Fascinating. And just to finish off, Justin, any thoughts in terms of outlook for the next quarter, next 6 months?
We're finding quite a few good opportunities at the moment in the listed infrastructure space. We've mentioned a couple of them today. So the US electric utilities are offering good valuation and growth, we think, with the energy transition. Another sector that we particularly like at the moment are the toll roads, which we've increased to around 12% of the portfolio at the moment. As I mentioned before, we see the traffic recovery as being fairly certain to happen over the next 12 months. So we're positive on the valuations of the toll roads as well. But in terms of what we look for, that hasn't really changed. We're looking for global listed infrastructure companies that are well managed and governed, with valuation support, inflation protection, and low volatility of cash flows well into the future. And we think that global listed infrastructure is well positioned versus global equities after what has been a very significant period of relative underperformance.
Yeah, great. Thanks for your time, Justin.
Thanks, Duncan.